So, hi, good evening, everyone. Okay, um, welcome back to Plan 258 today. Yeah. Did you see my screen? This one. Okay. So, hopefully, we will finish this core topic. Okay, it is quite big. So, we will discuss about decision under risk, and then the equivalent of this is minimum uh, expected opportunity loss. Okay. And then we will go deeper into decision tree and value of information and decision under utilities. At the end, you will have two assignments in model. Okay? So the fruit problems and decision risk. And then next week, we will have a midterm exam. Okay, so my question to you is, do we have class or it is only exam? Do you want to vote? Yes, George, what do you think?
I think, sir, everyone will agree that we will have no class, exam only.
Exam only. Okay. So in that case, I will open only. So next week we don't have class. Okay. If everyone agree that we have only exam. So the next meeting will be on 26th then. Yeah, March 26th. Okay, good. So the exam is in Moodle online. Okay. I will open from morning until evening. So 3 hours. So please do it rightly. Yeah. Yeah. The material from beginning until today. Okay. Yes, Lester.
Sir, I would like to ask, up to what topic is covered in the
Until today, from the beginning until what
until
we will
today?
discuss today.
Thank you, sir.
Yes. Okay. Okay. So let's start with the uh, beginning then. So we will have a decision under risk. So go to your Moodle. Okay, and you can download the slide there. Decision under risk. Yeah. Yeah. Under risk and then the minimum EOL. Yeah. Okay. Let's start with that. Uh, I will have my second screen. Yeah, share. Okay. Can you see the slide?
Yes, sir.
Okay. Put here. And lock screen. Okay, good. So, under this topic, we will discuss few things. Okay. So, what is risk? What is uncertainty? And of course, we will use decision under risk, yeah, and expected value. Okay. So, uh, from the big picture, we have discussed decision under uncertainty last meeting, right? And the next topic will be under utility and group decision making and game theory. So this is our topic. Yeah. So decision under risk. So right in the middle. Okay. And this is just to review what we discussed last meeting. So what is the difference between uncertainty and risk? Yeah. So uncertainty refer to not knowing what will happen in the future, right? So there is no data or little data available, or it is expensive to gather the data, yeah, or time consuming to get the data. Okay? So not even probability information exists. yeah, or even if exists, not that good. Yeah, so this is the main part there. Okay. And what is risk? Risk is also uncertainty, yeah, associated with undesirable outcome. Okay, so that include financial loss, damage, death, and so on. Of course, as the result or the consequence of certain decision or certain action that we make, or certain inaction. Okay, so and what is the difference between uncertainty and risk is this part. Yeah, we do have good probability information. So this is the main part there. Okay. Again, still in the review, we discussed last meeting. This is the decision under uncertainty. Yeah, you have a single person decision problem. Okay, and the probability distribution of the state of nature is unknown. Yeah. Okay, and then a decision is based on criterion from optimistic to pessimistic or somewhere in between, and you have uh, a few, yeah, five criterion that we discussed last meeting. Okay, today we will discuss decision under risk. So this is similar. Okay, so this is single person decision making problem. Okay, but the main part here is the probability distribution. Okay, occurrence of each state of nature is known. So this can be subjective probability, meaning based on your own opinion, yeah, or based on data. Okay, and then only one criterion actually, yeah, expected value, yeah, and the probability occurrence of the state of nature, okay, are the same for all alternatives. Yeah. So you see in this table, you will have additional row here called probability P1, P2 until Pn. Okay. So on top of the state of nature. So that means for all the alternative, yeah, A1, A2 until Am, yeah, they have this for each state of nature, the probability is the same. So the probability is not in the state of nature, is not in the alternative. Yeah, the probability is in the state of nature. Yeah. So, but uh, we can generalize this later in the next slide under decision tree. Yeah. Okay. So risk in finance, yeah, usually measure in either one of these. Yeah, one is called standard deviation. Yeah, of the outcomes. Okay, so the larger standard deviation, the larger the risk. Yeah, and second is the problem with standard deviation is there is a unit. Okay, so if you want to remove that unit, so you can have mean divided by standard deviation or standard deviation divided by mean. Yeah, this to remove the unit. So because they have the same unit, right? The mean and standard deviation. So when you make it either coefficient of variation or return to risk, okay, these two will become unitless. Yeah. So if you type in Google the name Sharpe ratio in finance, this is also basically return to risk or mean divided by standard deviation. Okay. So your data should be put in payoff matrix, yeah, similar to decision under uncertainty last meeting. Okay. The only difference is this probability information. Yeah, this probability information is added and assumed to be known. That means not necessarily uniform. Yeah, can be uniform, can be any other distribution. Okay, so we have n state of nature. Yeah, so I will use this, and then we have m state of nature, and our subscript index is k. Yeah, represent the column, and j, yeah, m represent the row or alternative. Okay, so our way to compute is only one criterion, which is called expected value, yeah, expected value approach. So this is basically probability multiplied by the gain or the cost, yeah, and then you take the average, yeah, based on the probability distribution. So the recommended decision alternative is the one that provide the best, yeah, expected value. So the best can be minimum or maximum. Yeah. If it is gain, then it is maximum. If it is cost, then it is minimum, right? So, and we assume, this is very important assumption, all the alternative, yeah, are uncorrelated. Yeah. Not necessarily exhaustive, but should be uncorrelated. Otherwise, uh, your probability is not correct. Okay. So this is the formula for EMV or EV. And sometimes we call it expected value, EV, or EMV with the monetary. Okay. So you have the probability multiplied by the payoff. If you look at the subscript here, okay, the probability is in the column. Okay, and then this is the payoff matrix here. G of row, comma, column. Okay, and then you sum over all columns. Okay, so basically this is the average. Okay, so and then to get the decision, okay, you just get the argmax, meaning maximize average, okay, and then you get the argument, yeah, over all the alternative. Okay, J is the alternative, right? Now, if you have gain table, this is the formula. But if you have a cost table, then of course you want to minimize, yeah, and then you get the argument of the minimum. Okay, so that's all the theory, yeah. So let's practice. Okay, we use the same, exactly the same example like last week with this under uncertainty, and this is under uncertainty. You can open your Excel, okay, just put it into a new sheet, okay, and the only things that you need to add is these three numbers, yeah, in the top. Okay, and then what you will do is you get the sum product, yeah, sum product of this probability, okay, and the value of each row. And that's called the EMV. Okay, and then what you will do, because this is gain, so you maximize. Okay, within all the EMV, you maximize. Okay, and then the decision is the arc of the arc max. So in that case, you get A. Okay, try to practice this first so that I will know if you get this or not. If you have any difficulty, you want to ask question or give comment, critics, that's fine. Done? Yes. Andrew, you want to share your screen? I will stop my sharing. Good. Um,
It has the same
Same result,
result
yeah.
with
Okay,
the
good.
Laplace.
Very good, very good. Did you make the result A and the arc max as result? No, you just do it manually.
Okay.
You can use formula, okay, so that it will. No, the max is fine. No, there is no arc
Oh,
max there. So to create the arc max, I think you need to use matching, equal match. Hmm. Yeah, match is the lookup value is the max, and then the lookup array is the ABC there. Okay, and then what is that? I think exact, maybe. Try. Oh no, not exact maybe. What is the next alternative? The third argument, mat type.
uh,
Okay, you try that.
I think,
Nice.
sir, maybe it's looking for 6.6
Okay.
from A to A to B, maybe this
Oh
one.
yeah. Sorry. You need to get the 6.6. Okay, one. Good. From that is the give it the row, yeah, and then you put VLOOKUP or lookup VLOOKUP equal VLOOKUP. Oh no. Hmm, what is the no, not VLOOKUP apa ya?
Maybe this way, sir.
Yeah,
uh,
no, if you know the index, not VLOOKUP, sorry, index. Uh,
Index.
index equal index. Okay, that ABC is the array, and then the row is one. Okay, close it.
Uh, Ayan.
Yes. Okay.
Yes.
Good. So you get automatic result. Yeah. So you can change
Okay.
now with the value in the table. Okay. There.
Oh,
Automatically changed. Is that better?
yes, sir.
Okay. Good. Okay. Good. I hope everyone can do also. Okay. The recording is with George. Yeah. George, you want to show something? Okay. George is nice. Can you also do the index and then match so that you can automatically get the alternative? Okay. Fine. Good. Let's go to the, next practice. Can you do it? practice 2. So I will share my screen. And this one. Okay, can you see my screen? Okay, let's do this together. Yeah. So we often ask this kind of question. Yeah, is gambling or a game or lottery fair or not? Like that. Yeah. So suppose you have this game. Yeah, the outcome is clear. So probability is given. Yeah. So 20% chance of winning is 100. 30% chance of winning 50, and then 50% chance of winning nothing. Okay. And then to join, you need to pay 20. Yeah. So the question is that game fair or not? Yeah. So fair game mean equal to 0. Yeah. The chance of winning and losing is 0. Okay. So then what to do? Yeah. Check the EMV. Yeah. So what is the EMV? 20 multiplied by 100. Yeah. 20%, 0.2. Yeah. Multiplied by 100. And then 0.3, 30% multiplied by 50. Yeah. Plus. Yeah. And then plus again 50% multiplied by 0. Right. So then you minus with 20. Yeah. So if that is not 0, so the game is unfair. Yeah. Okay. But in this case, unfair to whom? Yeah, unfair to you or unfair to the host? Yeah. So in
The
this
host.
example, this is unfair to the host. Yeah. So the the EMV of winning is 35, but you need to pay only 20, right? So in that case, unfair to the host. Because of that, so uh, you will, if you keep playing this game in the long run, okay, you will eventually win. And so this is the way to compute the lottery or gambling. Yeah. Is this clear or not? So now I want you to practice uh, practice 3. Okay. This is interesting. Okay. So this problem was posted by Blaise Pascal. Yeah. So there are two alternatives. Yeah? Whether you believe in God or you don't believe in God. Yeah. And there are also two states of nature, right? Whether God exists or God not exists. Okay. So and the probability that God exists, okay, whatever small it is not 0. Okay. So even if it is very, very small, it is not 0. Okay. So then if God does not exist, right? If God does not exist, and then you believe, okay, then your payoff is negative Z. Yeah. Why? Because you waste your time, you waste your energy, you waste your loyalty, yeah, to your belief. Negative. Yeah. Now, if you have not believed, okay, that God exists, but God actually exists, then your payoff will be uh, infinite, yeah, negative infinite, right? This is equivalent to eternal damnation to hell. Yeah. So then there are some other number here, x and y, which is just positive but finite payoff. Yeah. So now, can you compute the EMV of belief and non-belief, and what should be your decision? Okay. Try to do this. Yeah, this is just using algebra, not number. So you can just put any number there if you want, x, y, z. Yeah, when you finish, you can share and claim as your recitation. Okay. So what do you think? Anyone want to share screen? So infinite, you can put very large number. Okay, so for example, 100,000 or 1 million. Okay, and these are small integer. Yeah, x, y, z are just small integer, while the infinite is very large number. Anyone want to share screen? Is there any difficulty? And you already make the previous practice one. Okay, all you need to do is just change the number so you can get the result.
Hi, Prof. Can I
Yes.
share my screen?
Oh, sure, sure. I will stop my sharing. So you go. Mm, Lester.
Is my screen visible?
Can you see this? Oh yeah, no.
Can you see my screen now?
Yes.
In this portion, I just tried to combine the variables.
Mm-hmm.
So it turned out to be that in the final EMV equation, there's a bigger factor for the negative infinity
Mm-hmm. Mm-hmm.
as multiplied to the probability, and then it will be further added by a negative value of y as well when multiplied with the probability, and smaller addition of
Mm-hmm.
1. And then in terms of the believer equation, two positive contributions from the value of x and z multiplied by the probability, and then only one negative value, which is the payoff for believe non-existent.
Yes.
So I tried to put values. So in this portion, as you can see, I
Mm-hmm.
just tried to put a zero point 0.5 probability between the existent
Oh,
and
that's very
non-existent.
big. So you can just put very small number of probability.
Okay,
Say for example 0.001.
right.
Yes.
So if that's the case, Prof, and then
Yeah.
for the value of x and y, I just assumed it to be 5.
Yeah. Just
Then
any
for the
number.
value of z and negative 50, and then
Yeah.
for the negative infinity, I assumed it to be negative 100,000.
Okay.
And then computing for the EMV, which is the sum product of the probability
Mhm.
and the payoff scores. So this were the results. Negative 49.945 for
Mhm.
believers, and 95.005 for non-believers. And getting the argumentative maximum, um it would be the first option or alternative. The
Mm.
believers would always be the
Yeah.
decision between the
Yes.
two.
Yes. So it's very, so belief is the only logical uh,
Yes.
okay, result of this Pascal wager. Right. Thank you, Lester. How about the others? Is this okay with you? Yeah. So whatever small, okay, the positive probability that got existent maybe, yeah, because this is infinite, negative infinite. So then the EMV of non-believer would still be uh, negative infinite. Yeah. In that case, uh, EMV of belief is always okay, uh, higher, okay, or less negative. So this is a interesting philosophical, yeah, result of this decision under risk. Okay, so let's do this. Okay, now let's put it into money. So suppose there is an investor named Ali, yeah, who can invest, see, just small number, yeah, 100, yeah, either in a safe asset, say like government bond, okay, that brings say 10% return in 1 year, okay, or another alternative is he can invest in a risky asset, for example, stock, yeah, issued by a corporation, yeah, of course, higher risk, higher return, right? So in that case, 20% return. Okay. Now, assuming that if company have a good performance, yeah. But if the company performance is bad, you will get zero return. Mm. Okay. So question is, should he invest in stock or in bond? Yeah, this is related to your mm, assignment later. Okay. So in that case, what you need to do is to compute the probability. Okay, so we don't know the probability, so we just say P as your probability, and let's set it as 1 year. Okay, then based on that data that we have here, okay, so 100 times P, okay, and then 1 minus P, that is the uh, probability that 10% return. Okay. So you still get 110. Okay. Now, if you have the bond have no good state or bad, right? So in that case, still the same, yeah, 110 and 110. Yeah? But if you use a stock, you have two possibility, yeah. So 120 and 100, isn't it? Yeah. 20% or zero return. That means you come back to your original number value. Okay. In this example, yeah. So in this case, you have P multiplied by 120 plus 100 minus 100P. So in that case, you get 100 plus 20P. Okay. And then now you want to get P, the probability of good state. So then you make it equal between bond and EMV. Then you get P equal 1/2. So that means if the value of probability of good state, okay, larger than 1/2, so you will select stock. If less than 1/2, you will select bond. And this is the example. So now based on this practice, okay, I want you to go into a group and compute this. Okay. Now, similar, okay, this is actually your assignment. So when you finish, you can just submit this. Okay. Suppose you have now larger amount, so 10,000. Okay. Okay, you can either put in the bank. Okay, can interest like 3% interest per year. Okay. Or if you invest your money in the stock market, okay, now you have distribution, probability distribution. So this is when you remember, yeah, when you have a probability distribution of certain things of the payoff, then you understand that this is the problem of decision under risk. Okay, so just check this probability. You will gain 7% interest on average, but you have 10% risk to lose all your money. Wow. Okay, so now the same question, whether you will invest or put in the bank. Okay, but one thing here that did not tell is this is not just 1 year, but multi-years. So in that case, you need to compute it this way. Okay, so two alternative, right? The bank and the stocks. Okay, and you have the bank probability is one. The stock you have two probability, 0.9 and 0.1, and then you compute for multi-years. Okay, and then check in which year you should use bank and in which year you should use stock. Okay, is this kind of problem interesting enough? Okay, so try in that case. Yeah. Practical enough, right? For your own investment. Yeah. The same thing, yeah. So this is I'm talking about bank and stock, but you can just change that name into project, isn't it? Yeah. So different alternative and so on. So that's easy to just change name. Okay. So how many minutes you can finish this in a group? This is the assignment, basically. More complicated. But let's do this first. I will open breakout room for breakout room. How many minutes can you finish? 5 minutes? 10?
15, sir.
15. Okay, 15. So, okay. I will open breakout room. How many rooms? 4. Let participant choose. Okay. How to open? Open all room. Okay. Go.
The value is 9,000 for the
Uh,
stock price in year zero.
in the year zero, in the stock price, so you get 9. This one is,
Yeah,
I will share my screen.
sure.
In the year zero, this one.
Yes, the
So
9,000 and zero value.
9,000 is just 10,000. This one
Yes po.
multiply by 0.9 and then multiply by 0.
But we didn't consider it in the year zero of the stock risk value probability.
Is this the one that you question?
Yes. Just for clarification. Since we
Because
considered it in the interest probability, but why didn't we consider it in the risk probability of 0.1?
mm, wait. Because you did not in the year zero.
Yes, Prof.
Okay, so if you put this one with 0.1, what is the value? 1,000.
Negative 1,000. So it's
So you will still
8,000.
get 10,000 in that case total. Let me check. Yes. Decision. Decision under. True. Hmm. This one. Oh, yeah, you are right. So it should be,
Negative 1,000 and the total should be
yeah, you
8,000.
are right.
Right,
So
Prof?
correct. I think my formula was wrong. Let me show you. This one. So my formula was wrong.
All right. So it
Right.
didn't read
Should be
any.
this
Yeah.
one.
Yeah.
Right. So you're right. So in
Thanks.
that case, this is odd. Um, why this is before? This is one before. Because this is one before. This is the previous year. So if you want that, the
So it
previous,
should be 0 in the first year.
yeah, because this is the previous year, right?
Yes.
So in that case, in here, I need to put it in the previous year. So in that case, you need to insert rows and clear all of this. And if I copy this up, still 9,000, right?
0. Yes.
Yes, because this is in the previous year, pa. This one also, or this one based on this year, and this
Same with the
one,
0.9 this year. Yeah, same year.
mm,
That's my question. Why in the
no,
red?
should be in the same year. Yeah, so this is not correct in that case. Should be in the same year. So if this is in the same year, there, right? That will become even smaller.
Yes, maybe that's more logical since you already have a risk in the years.
Mm, yeah. I think this is the correct one. Yeah. Okay. Thank you. Let's stop. So I think this is the correct one. Should be in the same year, right?
Yes, Prof. Since
Mm,
the value should be considered at the end of the year. So basically
mm,
the
mm.
stock risk have been applied on your money.
Okay. Yeah, that's correct. So this is the supposed to be the graph.
Yes, but it is the same for year 1 to year 0 to year 5. You should invest it in the bank, and for the
Yeah,
next years should be in the stock.
right. But the value is not correct a while ago. So this is the correct one. Thank you. Yeah. Okay. So I will update the slide. Okay. Okay, so shall we call them back? What is the breakout room? Compose. They will come back in 1 minute. Are they coming back? No. Okay. See. Okay, shall you uh, present your result? Someone said that. Are you there? Okay, not stable. The H column. Oh yeah, okay. So it was my mistake. So okay, I'll show you the computation. Yeah, should be like this. Yeah. So my previous slide was wrong. So you get 10,000, and then these are the data that you input, right? And then this is just uh, interest. Yeah. This one should be if you use the interest, yeah, should be this one from the interest of the stocks. Okay. And then the column H is the one that Lester uh, provide me with the clue. So this is my previous computation was not correct. Yeah. So this is supposed to be 0.1 multiplied by this value. Yeah, but negative. Yeah. So in that case, you get something like this. Is this the correct one? So if you uh, put in the bank, okay, up to year 5, that is fine. But after year 5, the stock will be performs better. Yeah. Is that so? So how about in your case? What is your computation? Do you want to share it? Anyone? What is the result of your discussion a while ago? Lester, you want to say something or you want to show something?
Copy, Prof. But my groupmate is currently not in the meeting right now.
Oh, yeah.
So
Where
I
is it?
explored it on my own. So let me share my screen. Is my screen visible? Yeah. So based on the problem, the principal value, or you have 10,000 USD at the moment, and then you have two alternatives. It's either you put it in a bank or you invest it through stock market. So the probability um of 3% increase in the bank per year is 100%. While as mentioned in the problem, when you invest it in its stock, you'll have a probability of 90% of 7% increase, and 10% of whole whole of your money would be gone. So that's
Yeah.
-1. So computing for the interest per year in bank or and in stock. So it's in this orange cells. So in year zero, you have the initial amount of 10,000, and then after year zero, you'll have an interest of 3%. So this is cumulative or compounded interest. So basically, your current value of the previous years would get the interest of 3% for the bank and 7% for the stock market. And since there is a risk when you invest your money in the stock market of 10%, so this is where we will compute for the stock risk value and stock interest value, as well as the bank value. So since bank probability is 100%, so the computed amount in the previous computation would be the same for the value of in the bank. Meanwhile, for the stock interest, it would be divided into two amounts. One would be the 90% of the value of stock, and then the other one would be 10% for the risk. And then to get the total, you'll just add the interest and the risk. So this is the current value of your money in the stock market, considering the interest and the risk probability. So plotting it, so we will know where to invest our money or where to put our money. So the blue line here would be the value of your money in the bank for a year zero up to year 10. Meanwhile, the orange one would be the value of your money in the stock from year zero to year 10. So from here, we can see that the point of intersection is on year 6. Before year 6, it is advisable to put your money in the bank. And then after year 6, it would be advisable to invest your money in stock market.
Right. So if you aim for long term, okay, so you probably want to
Put it in the stock market
yes.
long term.
But if you are aiming for a short term, okay, below 5, below 6,
Just save your
so
money in the
better
bank.
go to the put your money in the bank. Yeah, given that data. Okay. So is there any other answer or comments from the other groups? Question probably. Yeah. So if not, you can just submit this in the assignment of decision and risk. Yeah, this is supposed to be individual, so you just submitted the one that you already computed today in the group. Okay. Right. So if you want to have more complex problem, so you can do the practice 6. Yeah. So there is a problem with the EV, yeah, EMV. Yeah. So risk is higher, right? When the probability to win is small, okay, but the gain is actually big. For example, in lottery. So, question is why people seems irrational to buy some kind of lottery. Yeah, so that kind of behavior is not covered in decision under risk, but it will be covered in the decision under utility. Right. So, but before going that, so shall we discuss the slide on minimum expected opportunity loss and decision tree? Yeah, that's what we will discuss next. So, can you see my slide? So you can download this also in Moodle. Yeah. So this is basically the extension of what we have discussed last week. Yeah, which is about regret. Remember that. Yeah, Savage. Okay, minimax regret. Okay, so regret is the same as opportunity loss, right? So, and then uh, we extend that regret into expected, yeah, expected or the average opportunity loss, EOL, yeah, EOL. Okay, and then we can make that onto a new technique called decision based on minimum expected opportunity loss. Yeah, but the most important part here is what is this? Yeah, EOL, and then what is the connection between this EOL with expected value of perfect information? And this is what we do. Two concepts that we will discuss, yeah, in this slide. So this is an alternative to EMV. Yeah. So you want to maximize expected monetary value or EMV. Yeah. Then we can also do similar, yeah, by minimizing expected opportunity loss. Yeah. So what you need to remember is minimizing EOL is exactly the same decision as maximizing EMV. Okay, so both are decision under risk because we know the probability distribution. Yeah. So to remind you, what is a regret or opportunity loss? And I copy again the slide last time. Okay, so regret is basically the absolute difference between the actual payoff and the optimum payoff. Yeah. So if you are using a gain table, so you maximize first the gain table for each column, okay, and then you minus with the payoff. If you have a cost table, okay, then you minimize first for each column, and then you take the difference. Yeah. So this must be positive, yeah, both sides. Okay. Now, in this slide, suppose you have the regret, okay, Rij is the regret, then you multiply that regret with the probability, yeah, of the state of nature, then you sum, okay, for all state of nature. That means for each row or alternative, you will get the expected opportunity loss. Because opportunity loss represent costs, okay, then you minimize. Okay, and then the decision alternative is the one that you take based on our mean. Okay, so I will use exactly the same example so that you can also practice. Okay, so these are the same number. Okay, like decision under uncertainty and decision under risk a while ago. Okay, but the change here is the probability. Yeah? The change here is the probability. So I put 0.8, 0.15, and 5. Yeah? The total probability must be 1. Okay. So to compute the regret, what you will do, you compute because this is gain, so you get the maximum payoff. Yeah. So this is the payoff. I just copy from this table. Okay. And then you take the maximum payoff. That means the maximum in each column. Yeah. So 5, 10, and 20. That is 20. So you just copy. 7, 5, and 3. That is 7. So you copy again. 9, 0, and minus 15. 9 is the maximum. So you copy. Yeah. So once you have these two table, I copy here. So this is the payoff, and this is the maximum payoff a while ago. Okay. So you get the regret. Yeah. This is the same result as Savage last time. Yeah. So this is the regret table. Okay. So you already did this last week. Okay. So what make it different is the next step. Yeah. Once you have the regret table, now you add the probability distribution here. Okay. Then you just sum product. Yeah, the probability and the regret for each row. Yeah, so the sum product of this probability, okay, and then this one, okay, will produce this one, EOL, yeah, 12, 8.75, 1.8. Yeah. And then because this is cost, yeah, not gain, EOL is expected opportunity loss. So the name itself is already lost. So that means you want to minimize. Okay. So once you get the minimum value, so you get argmax, yeah, index of the match in Excel. So you get C in this case. Can you practice this? So if you still have your practice last week, yeah, on the regret, all you need to do is just this step. Yeah, that's the last step to compute the expected opportunity loss. Yeah, and then get the minimum and arc mean. So try to use this one here. This C or minimum AOL, you can use equal index. Yeah, equal index. Okay, and then match. CH. Okay, so blah blah blah. Okay. The index of the this one. So we see. Yeah, this is the A. How much of the EOL. Yeah. So much will produce the row. The index will produce the value. So once you finish, you can share one or two of you to claim your recitation. Yes, Andrew. I will stop sharing. You will present. Go ahead. Yeah.
Hello, sir. So I just copied the previous one and
Yes.
then grayed out the criterion.
Okay.
And then I did the sum product.
Super.
I added the probabilities
Yeah. Super.
and took the minimum.
Yeah.
Sir,
The up mix. Yes.
question. Uh, you mentioned this will yield the same results with the
EMV.
uh, EMV.
Yes. If you use the same data, the same probability, yeah, the same result if you use EMV. The same result does not mean the value. The value is different, but the same decision. For example, A, B, C.
Okay.
One is
Will
EMV, the other one is EOL, so it's not the same. But the decision
okay.
should be the same.
Will that still be the case if the probabilities do not add up to
No, the probability
100%
should be
or
total must be one.
okay? That's
If
the
not,
assumption, sir.
no, probability, some probability is one is not assumption. That is the
It
axiom.
must be the case. Okay,
Yes,
okay.
yes. Right. That when we say probability compared to fuzzy, yeah, fuzzy the sum is not necessarily one. Okay, when we say probability, there are three axioms that you need to follow, and that axiom very strict. That's why, because that is strict, that's why they move into fuzzy, which is not such strict. Yeah.
Mm.
Okay, so the sum of probability must be one. That is very strict.
Thank you, sir.
Yeah, thank you. Great. Anyone else want to show and or short maybe? Okay, but can you follow or this is difficult for you or it's too easy? Yes, Lester.
I was just curious, sir. I cannot derive where did the index then the match on the Excel formula
Oh,
go?
you can share. I can help you.
Okay, okay, sir.
Okay. Did you get the match?
No,
Okay, so you get the match first in column H. Maybe you can get the match.
column H. Okay,
Yes,
match.
that one. Yes, equal match MA. Yes, lookup value is 1.8.
All right.
Okay, and then the lookup array is the EOL, the 12, 8 point something, the three of them. Okay, I think that the match type is exact.
Okay.
Okay, right. And then for the minimum EOL, there you put index equal index equal index. Yes, the the array is one ABC, and then you get the row is the yes the match a while ago, and then close. There, you got it.
All right. Thank you, Prof.
Yes,
It's clear now.
yes. Okay, so super. Anyone else still have some difficulty here? Okay, if not, you have this Excel already. Okay, in the next practice, all you need to do is just change the probability. Okay. Can you change the probability to 0.5, 0.2, 0.3? So the result will be what? Yes. The result will be A. That's correct. Yeah. So you see, if you have the calculator, so you start to see. Okay. So you're changing the probability. Okay. Suddenly your decision shift, yeah, from C to A. Can you see that? Okay. So yes, I will share my screen then. Yeah. So if you change the probability to 0.5, 0.2, and 0.3, yeah, okay, and you will get this one. Hey, can you open the decision under uncertainty of Savage minimax regret rule? What was the decision at that time? Remember, we used exactly the same data, right?
It was B.
It was B. Okay, in that case, this is interesting. Yeah, this is my question. Compare this minimum EOL computation result with the Savage minimax regret rule. Yeah, did we get the same decision? No. Right. So how can it was B? Yeah, and then here, this is the challenge. Yeah? We did not get exactly the same decision. Yeah, it was A and C, isn't it? So then, interesting challenge is, okay, let's put it into P1, P2, P3, huh? So that the P1, P2, P1 plus P2 plus P3 equal 1, right? The sum probability must be 1. So then, can you find P1 and P2, because P3 depends on P1 and P2, right? Can you find P1 and P2 in order to get the decision, the minimum EOL will select alternative B, which is similar to Savage. That's uh, interesting challenge. Yeah. So my computation might be wrong. So, but I tried that for all the possible values. I couldn't find. Yeah, I couldn't find any P1 and P2 that will make minimum AOL the same as Savage. So this is very nice new understanding. Yeah, that minimum AOL is not the same as Savage minimax regret. Okay, because you cannot even make that result that Savage did. Okay, so because I couldn't make in numerical, so I tried to do it mathematically. Yeah. So you can check on your own the detail. Okay, and it proved that it is not possible. Yeah, because probability cannot be negative, right? It should be between 0 to 1. So since probability cannot be negative, so no probability distribution of P1, P2, and 3 would make the minimum AOL to select alternative B. Yeah, on this example that we have. Okay, so in conclusion, this is another method, yeah, not the same as Savage. Okay, so next is compare this minimum AOL, yeah, exactly the same probability, the same uh, data, okay, to maximum EMV. Yeah, did we get the same result? Did you try? So you can try EMV and OOL and then put exactly the same probability, same data. Will you get the same decision? Not the same value. Yeah. So yeah, I did not provide the mathematical proof. Yeah, but there is a theorem telling that the minimum AOL always result at the same decision alternative as maximum EMV. Yeah, not the same value. Okay, but the same decision alternative. Okay, so up to here. Any question? Any comment? Maybe because regret alternative B are all non-zeros. Maybe. Okay. Yeah. For our example only, they are not the same. Yeah. So that, but in mathematics, one counter example is enough to fail the whole uh, theory. You know, that's the nice thing about mathematics. Yeah. So if you can just find a one counter example, okay, the whole theory collapse. That's why I find just one counter example here. So yes, Andrew.
Was it just a coincidence that the Savage Minimax regret rule is not possible to match with our EOL result, or is it
uh,
always never gonna be
no,
matching?
no, we cannot say always. We cannot say never. Okay, but we just prove that they are not the same.
Okay, okay.
Not always not always not the same. Can be the same. Can be not the same. Okay, but all what you need to do is to prove that they are not the same. If if they are the same, that is coincidence, right?
But is that all only depend on the our example specifically, or is that a
Uh,
general?
in our example, this is just one counter example. Okay, say you make hypothesis telling that they are the same. Okay, so and then you generate random number and then they are the same again. Okay, without the mathematics, you will just assume or make a hypothesis, make a theory. Yeah, a theory is very strong word. So make a hypothesis that they are the same, right? Even if you generate 1 million random examples and they are the same, it doesn't prove that you are right. It's just still hypothesis until you prove mathematically that they are not, they are always the same or not. That's very strong. When we say theory in that case, we need to prove mathematically. Okay. Then if you can just find one counter example that they are not the same, then the whole hypothesis that they are the same collapse. Like that. Yes, George.
Sir, I'm just wondering, sir, in real gambling games like casinos or lotteries, is the expected value usually negative for the player?
Usually. Uh, if you want, okay, it's a challenge for you, George. In Philippine, lottery is allowed, right?
Yes.
Even nationalized. Okay. In Indonesia, it's not allowed. So you can compute that 48, the lottery. See, what is the probability of winning? Because the rule is clear. So what is the probability of winning? And then the data is also public. So you can download that data. And then can you find the probability? Maybe you can win the lottery next time. Yeah. And then a question, how to improve the probability? Yeah. Okay, so next topic within the same slide of minimum expected opportunity loss is a perfect information. Okay, let me share. Can you see the slide? Okay. Where is the? Okay. So, what is perfect information? It means you know with certainty in advance, yeah, what event will occur. Wow. Can we measure that? Yes. Yeah. So, perfect information is a kind of fortune teller, wizard, okay, that knows exactly. Yeah. So, this is an ideal world, I know, okay? But at the same time, knowing this will give you the amount of WTP, yeah, willingness to pay for certain information to be certain. Yeah. For example, the probability. If you can get better information about that probability, okay, then you will have a better result. Right. So, of course, perfect information, the true perfect information, is rarely available. Yeah. So, but it is worth knowing, right? So let's uh, compute two numbers. Yeah, I will name it I0 and I1. Okay. So I0 is called value, yeah, without information. Okay. So this is the maximum expected value, yeah, that is obtained with no information about which state of nature actually happened. How do you get that? Yeah. So without perfect information about the state of nature, then you can uh, multiply the gain table with the probabilities, that exactly the one that you did, and then you maximize. Okay, that means you will get the average. What is this? EMV, isn't it? This is maximum ANV, right? This formula is basically maximum EMV. Okay. Okay. So let's give you example. We used exactly the same number. Okay. So the probability changed to this value. Yeah, 0 0.5, 0 0.2, 0 0.3. Okay. What you will do, you will get maximum EMV. That is the expected value without perfect information. Okay. So you have this table. What you will do, you compute the values. Yeah. This probability multiplied by this value per row, right? So you will get 6.6, 6.1, and then you maximize this, so you get 6.6. You did this already when you compute EMV, isn't it? So now I just rename it as expected value without perfect information. Are you okay with this? Yeah. So, okay. So if you get the expected value without perfect information, which is just maximum EMV that you did already, okay. Now we want to get the value with, Yeah, this is without. So now with perfect information. This is called, this is I0, so this is called I1. So how do you compute that? Okay, so if if we have perfect information on which state of nature will occur, right, then then for each state of nature, we will select the alternative that will yield the maximum payoff, right? So in that case, yeah, assuming you know, so then you first you maximize this gain table, yeah, for all rows, and then you multiply that with the probability of the state of nature, and then you sum. Okay? That is called a value with perfect information. Okay, let's do it with the example, exact the same example as before. Okay, I use the same example of the same table, right? The same probability. So what you will do, you get the maximum payoff first, yeah? So this is exactly what you did, yeah, to compute the regret a while ago. Yeah, so 5, 10, and 20 is 20, so then you copy. Yeah, 7, 5, and 3 is 7 maximum, right? So you copy and so. So this is the maximum payoff that you have. Okay. So now using this maximum payoff, you multiply with the probability. Huh? So of course you will get exact the same value. Okay. So this is called expected value with perfect information. So our goal, okay, having these two numbers is to compute what is called EVPI. Okay, so EVPI is expected value of perfect information. How much is the value of perfect information? Yeah, so you subtract I1 minus I0, and then you take the absolute value. Okay, what is this? This is the money, the willingness to pay, yeah, to get that perfect information. Okay, so using the same data, yeah, of probability and the time table. A while ago, we already got the I1 is 14.1, I0 is 6.6. So you take the difference, okay, and then you take the absolute value, so you get 7.5. Okay, so what is this? This is the maximum amount you are willing to pay for sub-perfect information. So this is the consultant fee or the fortune teller fee. Yeah, you are not willing to pay higher than this value. Okay, in the world of government and consultant, this is the consulting fee, maximum consulting fee. So if your value of consulting fee in the government bill beyond this value, that means clear corruption. Because mathematically we prove that this is perfect already. If beyond this, that is impossible. Clear, yeah? This is the maximum boundary. This is ideal world. Okay, I understand. So in the next slide of decision tree, you will learn about how to make it into real world. Yeah. So in this slide, at least you been introduced about EVPI, yeah? Expected value of perfect information. Okay. So this is the summary. Okay. Remember the oh yeah. If you look at the value of EVPI, it will be exactly the same as your minimum EOL. Yeah, that's mathematically interesting. Okay. So up to here, is there any question? This is just to introduce you with the next slide. Yes, George. Yes, the same decision.
Sir, I noticed, sir, that in our example that we are always solving, the alternatives always have different expected values. What if two alternatives have the same expected value? How should we decide between them?
So in that case, you cannot decide. So you need to use other method.
What method, sir?
Or later when we discuss about utility,
Oh, I see.
okay, you will start to see that. Okay, but that's a good advanced question. Yeah. So at this point, we use probability. Okay, what if they are the same? Yeah, exactly that problem. Okay, and so you cannot decide. Okay, in that case, you start to use utility. That means something your own opinion, your subjective, to make a difference. That's probably answer the question. Yeah. So if you use utility to change that probability into utility, okay, subjectively, then you start to see the difference. Okay. Now let's go to decision tree. Can you download the decision tree? This is okay. Let me go to. Did I share a screen? Okay, screen two. So in Revoledo, if you join, okay, I have several calculator that you can use if you want. Okay. Uh, this is the decision under uncertainty, okay, EMV, EOL, and then utility. Can you see that? Okay, and then also have decision tree. Yeah, exactly the same example that we have, which is fruit seller. Yeah, so you can draw your own decision tree. Okay, and you can create and then you solve that. Okay, if you use this tab, you will get if you solve, you will get the EMV, the AVPI, and so on. Later, you will get also the risk profile. If you okay, also here the market survey problems. So the decision tree will become much more complex. So if you solve this, okay, it will show that certain value, whether you will conduct survey or no survey, okay, and the result usually conducting survey is actually better. Yeah. This is to compute the two, yeah, literally. VPI a while ago, and EVSI, which is the sample information. It is based on the real data. Okay, so this is just the tool, so you can just use if you want. Yeah, this is just so let's come back to the slide. Yeah, decision tree and risk analysis. So this is what we will discuss in this slide. Okay, we will discuss decision tree. Okay, you can draw manually or you can just use the tool. Yeah. And then we will discuss about risk analysis. Yeah. Okay, so this part is a little bit complicated. So please bear with me when we discuss about Bayesian analysis. Okay, and the last one is the sensitivity analysis. Yeah. Okay, so in here we need to distinguish two jargon, yeah, two terminologies. Yeah. One is called decision strategy. Okay, so decision strategy is a strategy involving a sequence of decision. So you have a sequence of decision. Okay, that include the chance. That means you have some probability information. Okay, and you want to provide the optimal solution to your problem. Okay. The second is decision tree itself. It is just a graphical representation of the problem, yeah, to show that sequential nature, yeah, of the decision-making process. So let's go down to decision tree. It's a very simple graphical method. Okay, it's just three data structure. So you have the root, okay, and you have the leaf in here. Okay, and you have three types of node. Okay, the first type of node is called decision node. Usually box. Decision node is box or square like this. And then you have chance node. Usually we use circle. Okay. So in the chance node, you have the state of nature. Okay. Whether you have low demand, high demand, and so on. And then at the end, okay, you have leaf node. In the leaf node, these are the outcomes. Okay, so the payoff. So is this clear or not? Okay, so in decision node, okay, the branches are alternative. Okay, in the chance node, the branches are the state of nature. Okay, a leaf node, there is no branch. Okay, that means this is the outcome. Now, computation. The computation is rather simple. Okay, so you have this value of the outcomes, the payoff, and then you multiply this with the branch probability. Okay, so 100 times 0.6 like that. Yeah, and then this will become this branch value. Yeah, it's not here. We'll have branch, so the branch value is given. Multiply this, yeah, branch probability times the payoff. Once you have this branch value, now you sum of this branch probability times the payoff. Okay, then you will get the EV. In this chance node, you will get the EV. Okay, and then in decision node, you will just maximize the EV, the expected value of all branches. Okay, don't worry, I'll give you an example. Okay, so let's use this simple example. I call it fruit store problem. Okay, so can you identify here? This blue one is the decision node. Yeah, this yellow one is called the chance node. Okay? And these are the leaf node. It is I did not put any symbol here, just numbers. So payoff. Okay? And this is the payoff probability. Yeah? And this is the alternative. Yeah? High demand represent the state of nature. And can you notice also, yeah, the probability of high demand for all branches are the same. The probability of low demand for all branches are the same. Okay, so this is just to connect between decision tree with the matrix a while ago. Yeah, not necessarily the same, but only if you want to connect with the matrix. Okay, so what's the problem? Okay, So suppose you have a fruit store and you are facing inventory problem. Yeah. So what's the problem? If the demand is high and you order a lot of fruits for your store, okay, you will gain much profit. No, that's good things, right? But if the demand is high and you order only little of that fruit items, you will lose opportunity, yeah, regret, yeah, to sell. Now, if the demand is low and you order a lot, okay, so the fruit will perish and you lost a lot. And if the demand is low and you only have little fruit, you gain only little profit. Right. That's common, yeah, common problem. So can we put this problem into decision tree and payoff matrix? Yeah. Okay. So now remember, decision tree is actually more general than the payoff matrix. Okay. So every payoff matrix, there is a corresponding decision tree. But the reverse is not true. Yeah. Not all decision tree can be converted back to payoff matrix. Yeah. Why? Because if they are the same, yeah, like in this example a while ago, high demand 0.6, high demand 0.6, low demand 0.4, low demand 0.4. Then, if the probability of each state of nature are the same for all branches, yeah, then yes, you can put that into matrix. Yeah, but if they are not the same, then you still have decision tree, but you cannot convert that to payoff matrix. Is that okay? Okay. Now, can you uh, see the connection between decision tree and the payoff matrix? Yeah. Okay. So if you have two alternatives, isn't it? Big order and small order, and you have two state of nature, high demand or low demand. Okay. And these are the probability for each state of nature, yeah, 60% and 40%. Okay. And these are the payoff. Then you connect, yeah, between this payoff matrix with the decision tree. So can you see the connection? Can you draw from decision tree? Can you get back the payoff matrix? From the payoff matrix, can you get the decision tree? Yes or no? This is first. Any question? Any comment? Okay, so no problem, right? Between decision tree and payoff matrix, yeah. Okay, thank you. Good. So then these are the steps. Yeah, I make it very simple step by step so that you can actually compute manually. Okay. So you want to find the optimum decision alternative based on decision tree. Okay. So first you go from the leaf node. Yeah. So you compute the EV for each leaf. Okay, and then you compute the EVs for the chance node, okay, and then you go to the decision node and maximize this EV, yeah, and then you identify the best decision. So I will use these 4 steps, yeah, in the next few slides. Is that okay? So let's go with the same problem, yeah. So this is our payoff matrix. Okay, and this is our decision tree. Yeah. So if you still have problem how to convert one into the others, so you say now. Okay, otherwise you are in trouble next step. Okay, so this one, high demand, big order. So you go to big order, high demand. So you put 100 here. Yeah. So big order, low demand, negative 100. So big order, low demand, so you put negative 100 here. Simple, yeah? Yeah. So, okay, let's go to the first step, which is compute EV of its leaf. So you go to the leaf, okay, so you compute the EV. EV is just the branch probability times the payoff. So 60% times 100, so you get 60. Yeah. 40% times negative 100, so you get negative 40. Right? The same thing here. 60% times 10, so you get negative 6. 40% times 50, you get 20. Okay, so the first step is to compute the EV. Is this clear or not? Yeah. So remember, yeah. So the end, the leaf node is just the outcome of the payoff. Yeah. The EV is the branch probability times the payoff. Okay. Up to here, is that clear or not? Yeah, easy. Yeah. Just multiply these two numbers. And then the second step is to compute the EV for the chance node. Yeah, so you get this EV, yeah, 60 and minus 40. So then you combine. So the chance node, now you combine, yeah, because this chance node have two branches, yeah, so you sum, yeah, 60 plus minus 40. Yeah, so 60 plus minus 40. So 60 minus 40 is 20. So the same thing here. A while ago, we have minus 6 and plus 20. So you sum, so you get 14. Okay. So this is basically the expected value of ordering many fruits and expected value of ordering small. Yeah. So I put here average gain of big order and average gain of small order. Up to here, is it clear? Yeah. Again, so that you remember, yeah, the branch is basically the state of nature. Okay, and then the EV of the branch is just the sum, yeah, of the branch probability multiplied by the EV. Yeah. The third step and the fourth step is rather simple. Just maximize. Now you get 20 and 14 here, so you get the maximum 20. Yeah. So then identify the best decision. You just make a bold, okay, of the line here to tell that this is the big, this is the decision that we use. Okay. So remember, yeah, the branch of decision node is the alternative. Okay, so you make decision based on maximizing the EV of all branches. Up to here, is this clear or not? No problem. Okay, so if you want to use Excel, okay, so you can still use exactly the same. Okay, so the same as decision under risk. Actually, this is still decision under risk. Yeah, so you get the 0.6 here, and of course this is 1 minus, so this should be 0.4. And this is the data that you have. Okay, and then you compute the 0.6 multiplied by 100, so you get 60. 0.4 multiplied by minus 100, you get minus 40. And then you sum, so you get 20 and 14 here. Okay, and then you maximize. Okay, this is the result. And the arc is the big order. Okay. So, okay, this is exactly what George was asking. Yeah, what happened is the same probability here, and you get exactly the same. So in this case, you cannot decide, yeah, because the expected value are all equal. Okay, so do you want to practice this to get this value? You did. Maybe it's better if you get this expected value table. Okay. Okay, good. Uh, hmm. Did you get this table or not? My question. This one. Because if you don't, later you get confused. I will build upon this example. Okay. Okay, let's go to the next topic, which is risk analysis. Okay, this is the study of possible payoff and probabilities, yeah, associated with that decision alternative or decision strategy, yeah, the sequence of decision. So we'll discuss about risk profile, value of information. Yeah, we already discussed EVPI a while ago. Now I want to introduce you with EVSI, yeah, expected value of sample information, which is based on real world and the sensitivity analysis. Yeah. So what is the risk profile? Yeah, risk profile is just a chart, okay, to show the probability distribution, okay, of the selected payoff, yeah, that you design. Yeah, a while ago, uh, this one, okay, you select the best decision is pick order. Yeah, that pick order is based on this probability that we use. Yeah, so pick order is 0.6 and 0.4 probability, and this is the EV, yeah, 60 and minus 40, isn't it? So this is the one that we use to create the risk profile. Yeah. So okay. So based on this risk profile of the optimum decision, okay, you want to compare a before and after study like that. Okay, so how the profile shift change. Yeah, remember because this is probability, so the area under the curve is supposed to be one. Okay, so based on our fruit store problem a while ago, okay, so we have 60% of value of 100. So I put 100 here, and then the value is 60. And then we have 40% of negative 100. So we put negative 100 here, and then this is 40%. Yeah. Based on what? Based on the big order. Up to here, the risk profile, how to draw the risk profile. Yeah. In the calculator, in Revolut, you can get this also. Exactly the same. Okay. So yeah, you're supposed to create your own payoff table, yeah, with the probability of state of nature. Okay, so provide certain number of alternative and state of nature, and then can you make decision tree, yeah, and then you can make the risk profile. Okay, so you can do it at home. Okay, So now let's go to the main topic. It is about value of information. This is actually the one that we need to teach in this transportation planning course, right? So why do government and company hire consultant? Okay, how much is the investigation worth to study? Yeah. The same thing. Why do you conduct a feasibility study? Yeah. How much is the real value of that feasibility study? Yeah. The same thing. Say in a company, you build what is called database, yeah, management information system. Okay. So how much value of information contained in that database software? Yeah. This seems different question, yeah, but actually the answer is the same. Yeah. Why do we need to build a prototype? Yeah. Why we invest in building prototype? Yeah. How much value do we gain by building a prototype first rather than directly build on the real world? Yeah. The same thing. So we do experiment or simulation first before the real project. Yeah. Yeah. Depending on that, you want to know how much is actually that study worth. Yeah, this is what is called value of information. Okay. So how much important information we would like to gain before we spend time, effort, and money to hire a consultant, okay, to study or to purchase a piece of software, yeah, to model, to prototype, and to perform the experiment. Okay, so this is very fundamental, yeah, the need of information, okay, so that you will have what is called informed decision, isn't it? Okay, so people are willing to pay good sum of money, yeah, for that process information. Yeah, many of you are basically working as consultant. Okay, so how much is the value, your value worth? And you can ask yourself, yeah, whether that is correct or not. Okay, so value of information means knowing with certainty. This is the same as before, yeah, in advance, yeah, what event will occur. So this is a fortune teller. Yeah? How much are you willing to pay to obtain that fortune teller information? Okay, and for that perfect information, we already discussed a while ago. Okay, what is called EVPI. Yeah, so in your previous slide, we discussed about I1 and I0. Okay, with all the examples. Yeah, this is just a review. Okay, so you get the EVPI with this the difference, yeah, between uh, value with perfect information and value without perfect information. Yeah. So we can apply this to next problem with this fruit store problem. Okay. I hope by providing this example 2 times, you get the idea. Okay. So we have decided a while ago using the decision tree, yeah, that you want to select big order, yeah, without information about which state of nature will happen, right? You don't know whether it is peak demand or low demand. Okay. And then you have decided without any knowledge that the demand will be high or low tomorrow. So then you put that as I0, yeah, value without information, which is this 20 a while ago. Okay. So Now, you already got the EV without, yeah. Now we want to get the EV with information, yeah, perfect information. How do you get that? Say, I said here, this is the decision tree that we have. Okay, so say a perfect fortune teller telling you that the demand will be high tomorrow. Remember, this is an ideal condition. Yeah. So, what will be your decision? Okay. Then you will, oh, you know that tomorrow will be high demand. Okay. Then what you will do is maximizing between this 100 and minus 10, isn't it? Okay. Then you will select big order because 100 is larger than minus 10. Okay. So what is the expected value? 100 times 60%. Yeah. So the probability is still there because actually you are still not sure. No. What is the decision if you know for sure that the demand will be low now? It's not high. It's the other way around. Then you will maximize between this value minus 100 and 50, isn't it? All right. And then you get 50, yeah, minus this one. This is positive. Okay. Then you multiply by that probability. Yeah. So now you combine these two knowledge. Okay. Then the expected value with perfect information will be okay 0.6. Okay. Multiply by the maximum of 100 and minus 10, and then 0.4 multiply by the maximum of minus 150. Yeah. So you will get 80. In that case, your EVPI is just the I1 minus I0. This is I1. Yeah. RY level, we have I0. Yeah, basically EMV, this one. So then you get 60. What is this 60? This is the maximum you are willing to pay, yeah, to get certainty of information. Yeah, this is the maximum you are willing to pay that consultant, that market research, that fortune teller. Yeah, if the prediction is 100% reliable, this is maximum you are willing to pay. No more than this. Up to here, is it clear or not? Any question? Oh, clear? Okay, thank you, thank you. I was worried you were not clear with this part. Okay. Then we can continue with the real world. Yeah, perfect information is not real, right? That perfect fortune teller does not exist. Okay, but market research, market study, right, or consultant exists, right? Okay, experiment or model or software exists. Yeah, so this is imperfect information. Oh, okay. So we have perfect information, which is impossible to find. Okay, but imperfect information exists. So we will use this. Now, using this, say, let's name it market study. Okay, using this market study, you have two possible results. One is favorable, the other one is unfavorable. Favorable means your consultant is very good, yeah, the result is correct or reliable. Unfavorable means the result is incorrect, yeah, or not reliable. Yeah. but you know the probability, because this is decision under risk. So the main assumption is you know the probability. At least you can value, yeah, the probability based on your own opinion. Is that okay? Okay. To understand this, okay, I need to introduce you with several jargon or terminology. Okay, please bear with me. Yeah. So this is in statistic. Yeah. We have what is called prior, conditional probability, which is either posterior or likelihood, and we have also what is called Bayes rule. As you can search this, yeah, in Wikipedia or in Google. Okay, so I will just give a brief review. Yeah? So when we have this payoff table with probability, something like this, right? So this probability that you assign, this is called prior. Yeah? This is the probability of the state of nature. Okay, of course, the sum of all prior probability must be 1, right? Yeah, just remember the name. Yeah, the one that we put here is called prior. Is that okay? Next. Now, in the market study, okay, you have two possibility, right? Favorable or unfavorable. Yeah. For each state of nature, S1, S2, and so on. Yeah. Remember the state of nature a while ago was in the column, so I put it in the row now. Okay. For each state of nature, okay, you have two possibility in here, either favorable or unfavorable for that market study. Yeah, favorable mean correct. Yeah, unfavorable mean incorrect for the given state of nature. So this probability is called likelihood. Yeah, with this conditional probability. So this is the symbol. The probability, yeah, given this is S1, the state of nature is S1. This bar represent, you call it given. Yeah, the probability that the study is favorable given that this is state of nature S1. Yeah. And then P unfavorable mean the probability of unfavorable study given that the state of nature is S1 and so on. Of course, within each state of nature, the sum of that likelihood probability must be 1. Okay, just the name so that you will know. Next, we need to reverse probability. Yeah, this is called posterior. Okay, so can you see the symbol here? Probability that the market study is favorable given the state of nature. Yeah, this is called likelihood. Now, if we reverse, okay, we want to know given, okay, that the study is either favorable or unfavorable. Okay, what is the state of nature? Yeah, yeah. So this is called posterior probability. Yeah. So that remember, yeah, the study can be favorable or unfavorable with certain probability. So when we say posterior probability is another conditional probability. Yeah. But this is conditional probability of the state of nature, given, yeah, that the study is already uh, known to be unfavorable or favorable, correct or incorrect. Okay. Again, I just introduced the name so that later you will know which one which. Yeah. The last part or the last two, yeah, is joint probability. That means you have the prior multiplied by the likelihood. Yeah. So that you have a probability of favorable or probability of unfavorable. Yeah, that study. The last one is this called Bayes theorem. Yeah, this is Simple but unique. Yeah. So if you want to get the posterior, yeah, this is the formula. If you want to get the formula, the posterior, you just multiply the likelihood times the prior. Okay. And then you sum all of them, and then each of this multiplication is called posterior. Yeah? So this is the general formula of Bayes' theorem. So we put it into our study. So the likelihood is this one, right? P favorable given S. Yeah, this is the state of nature. The prior is this one. Yeah, probability of each state of nature. Right. And then you just sum for all the state of nature. Okay. And then for each of these divided by the sum, you will get the posterior. Okay, that's all. The jargon, yeah, a lot, yeah. So now let's compute. Okay, using exactly the same data. So this is the new data that given to you. Okay, so I put here given. Okay, so this is the likelihood of market study. Yeah, that if it is high demand. Okay, so the market study is correct 90% of the time. Yeah, and 10% incorrect. Yeah, but if it is low demand, it's the other way around. Okay, correct is only 20% and incorrect 80%. Yeah, so this is bias. Yeah, this market study is clearly biased. So I put here yellow. This is the one that you input, okay? And this is one minus, right? Because the sum must be one. Remember. Yeah. So this is in the actual table with the symbol. Yeah. In Excel, I put it this way. Is it okay? Yeah, this is given. Yeah. Next, you compute now. Now you compute joint probability. Okay. So a while ago, this is given. So I'll put here. Okay. So then you compute with joint probability. Okay. So you multiply the prior, okay, of high demand, multiply by 0.9 here. So you get 0.54, isn't it? And so on. Yeah. So for each of this, you just multiply. Yeah, 0.6 multiplied by 0.1, so you get 0.06. Okay. And so on. So you get all of this table. This is the table of joint probability. Okay. And then you sum to the bottom. Okay. So what is this sum? This sum represent the joint, yeah, which is the probability that the market study is correct and the probability that the market study is incorrect. Wow, look at the probability of correct is only 62%. So actually this market study is not that good, yeah. So only 62% correct, yeah. 38% incorrect. Okay, no problem. Let us see what will happen with this bad market study. Okay, so then we can compute now the posterior probability. So I copy here the joint probability from the previous slide. Okay, so this one. So then we can compute now the posterior, yeah. So given this likelihood, and the joint probability. Okay, then you can compute the posterior probability. Yeah, so this is the formula. Okay, so probability of low demand, that this is incorrect. Yeah, of course, that is low demand times incorrect given low demand, and so on. Yeah, so you can see we get four numbers again. Yeah, 84%, 16%, 87%, and 13%. Yeah, so I put these four numbers into a table, with sum must be one. Yeah, because posterior probability, the sum must be one. Okay, yeah, and then from here, okay, you can get the probability of market study. Yeah, and the posterior. Yeah, this is the one that I computed a while ago. I just summarized back. Okay, this is the value. Okay, so given this value, what will happen? We can compute. Yeah, we can compute the decision tree. Yeah, it takes very long time to draw this tree. Yeah, this was before I draw this manually. Yeah, so you see here, you have earlier, okay, no study, right? This is the part without study. Okay, and then this below here is the part with study, market study, and market study can have two possibility, correct or incorrect. Yeah, with only 62% correct. Yeah, almost 40% incorrect. And then of course, correct can be big order and small order. But now the probability change, yeah, based on the posterior. Yeah, these are the value 87, 13, yeah, 16, 84. This is based on this value, yeah, in the posterior. Is that okay or not? Yeah, quite a long time to compute. That's why I put the calculator anyway. Okay, once you have this, then of course, based on this, you can compute the decision tree as before. Yeah. Okay, so this value in the below is based on market study and based on the posterior probability. Yeah, can you see that? 87, 16, 13, 84. Yeah, exactly. 87, 13, 16, 84. Okay. So then you can compute. Yeah. So you compute the EV, right, as before. After that, what you will do, you get the decision. Yeah. So the EV for market study, we get the two possibility. One is correct and incorrect, right? So I computed one by one for each of these. These are the probability, right, based on the posterior. Okay, and then we compute for big order and small order, high demand and low demand. Yeah, so this is the value. Basically, this is the value that we put into the table. Okay, here. So you get the sum. So you get the EV. Big order is 74 and small order is 40. Yeah, this is for market study. And then with that, you put them together. Oh, this is the actual decision. Yeah. Okay. And then again, because this is the decision node, so you need to select the maximum, right? So you get the maximum. Okay. And this one you already got a while ago, 20 a while ago. Okay. Now we have this three possible decision. Now, but you have another chance node here. So that means you need to multiply. Yeah, this 62 with 74, 38 with 40, right? So once you multiply, okay, so you get the EV for market study. Yeah, so Once you multiply this, you get this value, okay, with this small order. Yeah. So if it is correct, big order. If it is incorrect, it will say small order. And then from there, you can get the last part, yeah, whether you use study or no study. Yeah. So without study, your EV is 20. With market study, your EV is 61. So clearly, market study win. Yeah. Even though, okay, the correctness of market study is only 62%. So, okay, if I know that, then I can compute the consultant, the market study value, isn't it? So that called EVPS. Yeah. So what is the optimal decision? Yeah, need to study. Okay. So despite the market study is far from perfect, yeah, then we can check the value of information. Okay. So here it is, the new term now. Yeah. EVSI is called expected value of sample information. Yeah. This is exactly similar to EVPI, which is based on perfect information. Okay. But now you base it on the real world, which is you compute the expected value from the actual data, yeah, of that probability a while ago. Yeah. So how to compute this? Yeah. So FESI, yeah, let's name it S0 and S1. And then again, similar, you just minus. So this one, okay, you use based on the probability multiplied by this formula. Okay. And if SI is the same, you maximize first the gain, yeah, and then you multiply by the probability. So this is similar to EVPI. The only difference is actually the probability values. Can you see that? Okay. So we are using posterior now. Okay, instead of this is posterior and this is the prior, isn't it? Okay. So then we have efficiency. Yeah. If you have the EVSI and you have the EVPI, then you will know how much is the efficiency of your market study. Another term now, you can get another index. Yeah. So come back to the numbers. So you get a while ago 20 without study. With study, you get 61.4, right? So in that case, you minus. So you get EVSI is based on this simple minus, yeah. 61.4 minus 20, so you get EVSI 41. Yeah. So and then you divide by the EVPI, okay, so you get 69% efficiency. Okay. What's the meaning? This is maximum you are willing to pay for that market study. Yeah, this is the dollar or the pesos amount. Yeah. And this is the efficiency of that market study you can mention also. So until here, is there any question? Do I do it too fast? Yeah, you probably need to practice in order to gain better understanding of this. Yeah. So once you have this, so you can start to draw the risk profile, and you can also do the usual sensitivity analysis. Yeah. So because without study, we have this risk profile, right? So 60% and 100, 40% and minus 100. So now with market study, okay, this is the actual decision a while ago, right? So this is the one that you use. 1, 2, 3, 4. So the risk profile shift, yeah, from like this without study now more distributed, yeah, more distributed. So because of this risk profile, you will see that more gain than losing. Okay, so this is the risk profile of market study. You can see the shift, yeah, before and after. Okay, and the last one is just to the sensitivity analysis. Yeah, so you want to study how the change in the probability, yeah, will actually change the payoff. Yeah, so in this case, you just treat one of the probability of parameter, okay, and then remember total probability is one. In that case, you just get the range of probability, so you get the uh, value. You can use data table in Excel, yeah, to get this, yeah, whether what is the probability of high demand, for example, in order if the probability of high demand is low, then you will select small order. Otherwise, you will select big order, yeah, until about 0.5, yeah. Okay, and then the yeah, 0. More than 0.5, I think 0.55. Okay, so then you will see this, yeah, sensitivity graph. Okay, so with this, I guess we discuss all things for today. Yeah, this is until here is the part of the exam. Next week. We still have like 10 minutes or more for discussion or practice if you want. Yes, George.
Sir, question about the exam for next week.
Exam.
Yeah, exam for next week, sir. So, in that revo, I just want to clarify what's the meaning of this correct minus wrong in the exam. For example, if there
Okay.
are 10 questions and I get 7 correct answer, it will be 7 minus 3. Then my score will be 4. Something like that. Actually,
yes, so
yeah,
something like that.
Yes.
So,
Actually, sir, 7 is a very good score. But if you will deduct by your mistake, which is 3, then now you fail the exam.
yeah, exactly. So that's why you need to study well. Okay, because the exam is multiple choice. Okay, and I will not make minus that big. So I think the minus is automatic minus 10% only. So you have, for example, you have 5 possible answer. Okay, and 3 of them must be correct. Example, and you answer all. Okay, then you will get 1 minus 40%. That means you get only 60 for each question. Okay, so otherwise people will just select anything. That's unfair also, right? So it's not right minus wrong in the same equal probability distribution. Yeah, minus is only 10%. Yes, Roger.
Prof, is my understanding correct that we are allowed 2 attempts?
Correct. Correct.
So,
The first attempt, if you do the exam, okay, and then you will only get the score, but you will not get the actual result. Yeah, the actual result will be the following day open for you. Okay, that's why you can get the whole day. Okay, so you have 2 attempts, and then the first attempt, say you get whatever number, say 70, 80, okay, and then you remember, you can guess, okay, what was the wrong thing there, but it will not show. Then in the second attempt, you can do it again, okay, and I hope it is better. Yeah. If it is not, the first attempt will, we will get the maximum between the two attempts. So you don't need to worry. Yeah. Good enough. So study very well. Okay. So, and prepare your own calculator. So, because the number of questions, I think is like 20 question and all computation, right? Okay. But the simplest, if you don't know, you just answer all. It will minus, but the minus is not that big. Yeah. But if you are sure, so don't answer. Yeah. So if you are blind, you just answer all, you will get probably around 70 or 80, minimum 60. Okay? So if you get less than 60, meaning you did not study. Okay. Because even if you don't study and then you just answer all strategically, you still get like, yeah, 60. Right? Because one of them must be the answer, and you have five answer. Okay, either one or two or three or four or five, right? So if only one, that means you minus 40. That means 60%. So that means your minimum grade must be 60. That's minimum. But if you go below that, something is wrong with you, right? Because you go beyond the impossible. Okay. So study well. No need to worry, but at the same time, you just prepare. Okay. And look at the course syllabus. The percentage of midterm is very small. The group project is actually very big. So even if you fail the midterm exam, you will not fail. Is that okay? So you don't need to worry.
Sir, one more question.
Yes?
Sir, I'd like to ask also the coverage of the midterm exam.
From the beginning until
From the
today.
beginning, this expected value in the decision trees are also included in the exam?
Yes, of course. And you also have the assignment, two assignments. Okay. But we will not have lecture next week. Yeah. So dedicated for your midterm exam only. Yes, Lester.
Sorry, sir, I lost my connection earlier, but I was just trying to compute for the, what do you call this? Posterior probability,
Mm-hmm.
but I can't get the value of 0.84 using the figures in the slide.
0.84.
Yes. Slide number 37.
Okay. So let's go back here. Share screen. Second screen. This one.
Slide
This is the one.
37, sir. Posterior probability.
This is 37. No.
Yes.
Posterior. Okay. So this is clear. This slide is clear or not?
Yes,
This
that's
this is
clear, sir.
given.
The next slide.
The next one. Okay. This one is clear or not?
Clear also.
Okay. Good. This
Yeah,
one is
that
not
one.
clear.
Yeah. The 0.84 value.
This
Since
one.
to compute it using these figures on the left and
Okay. So the probability of low demand is 0.4, correct?
yes, correct.
And then the probability incorrect and low demand. incorrect and low demand 32. This one. Correct? This one.
Yes.
And then high demand 60%. Incorrect high demand. Incorrect and high demand. This one 0.06 here. And then the other one is the same, no? 0.4 times 30. So this value is not 0.84.
84. Yes, it's not 0.84.
Oh, what is this?
It's 0.78.
Oh, really?
Yes, based on my calculation, sir. If
Oh,
the figures on the left are correct.
oh, wait. 0.78. Decision 3. Folio information. This one? Oh, this one?
Yes. For the 0.84 value, sir.
0.84. This one?
Yes, sir.
This one is this value 32 divided by 38. Did you use the same? How do you get that? 78.
So we will not, sorry, sir. So we will not consider the probability 0.6 and zero point 0.4 because those values were based on the joint probability. And based on the formula you've presented, it should be multiplied with what do you call that? The prior
No,
probability.
this is the posterior. Okay,
Yes.
and then you multiply later with the 0.6. This one, right? This one. We will not multiply with the 0.6 and 0.4.
For the posterior probability, sir.
I think so. Okay, I can put this seat in Revoletu in Moodle so that you can also study. Is that okay? Okay, so I will upload later so you can study this.
Yes, sir. I was just confused because on the slide, it was multiplied with 0.6 and 0.4 on the
Okay,
presentation for the posterior probability.
it should be correct. Okay, yeah, but thank you for making that into. So I will update and check back. Okay, if I'm correct, I will post this one. If not correct, I will fix this and then send to the Moodle
All right.
tonight.
Thank you, sir.
Is that okay? Yeah, thank you for
Yes, thank you.
the. So I think I use the same here. Oh, maybe you are correct. No. Okay, let me check later. Yeah, if my computation is correct or incorrect. Okay, and come back to you with this seat in model. Is that okay? Yeah. So thank you for today. Okay. And I hope this is useful information for you. Yeah. George, can you send me the recording later?
Yes, sir.
Or you can distribute to all. Yeah. Thank you all, and thank you for today.
Thank you, sir.
Okay.
Bye, sir.
See you next 2 weeks. Yeah.
Thank you, Prof.
You. Bye bye.
Thank you, sir.